We've all been taught the same basic financial rule. If you want your money to be absolutely safe, lock it away in a savings account. But keeping your cash parked in that account guarantees one thing: your money is losing its purchasing power every single day. This chart breaks down the actual numbers. If you deposit 5 lakhs into a standard savings account, paying a 2.5% annual yield, you earn a gross return of about 12,500 rupees over the year. However, inflation eats away at that gain. With the official consumer price index at roughly 3.48%, you lose 17,400 rupees of real purchasing power from your total. After 1 year, your 5 lakhs has actually lost around 4,900 rupees in real spendable value. That negative real return is essentially a convenience fee you're paying for the ability to access cash instantly through an ATM or UPI. Banks are highly efficient businesses. They do not hold your money out of charity. They operate on a model called net interest margin. This split-screen graphic shows how the bank sits as the middleman between you and the credit market. On the input side, the bank takes your 5 lakh deposit and pays you that 2.5% yield. The moment your money clears, they lend it right back out. Your cash funds a home loan at 9% or personal credit card debt charging anywhere from 15 to 36% interest. The bank pays you 2.5%, charges the borrower much more, and quietly pockets the 3 to 4% difference as profit. To stop paying that middleman margin, you have to trade a little bit of instant liquidity for strategic yield. Let's compare 4 alternative financial vehicles that bypass the bank. When people realize their savings account is losing money, they often move it into a fixed deposit. This matrix breaks down the FD math. Locking that 5 lakh deposit into an FD secures a predictable gross return of 7%. However, FDs are notoriously tax inefficient. That interest is added directly to your taxable income. If you fall into the 30% tax slab, a massive chunk of your return goes straight to taxes. Once you factor in inflation plus the standard early withdrawal penalty, your real net return drops to roughly 6,400 rupees. This brings us to liquid mutual funds. These are designed for cash you might need within days rather than hours. A liquid fund takes your money and invests it in highly stable, short-term instruments, like 91-day treasury bills and corporate commercial papers. By bypassing the retail banking margin, liquid funds currently generate a gross return between 6.5 and 7%. The trade-off is a slight delay in liquidity. These operate on a T+1 timeline, meaning if you request your cash on a weekend, you won't see it until the next business day. Unlike an FD where you're taxed on the interest annually, liquid funds trigger short-term capital gains tax only when you withdraw. After factoring in inflation and taxes, your real net return reaches around 10,600 rupees. By accepting a 24-hour delay in access, you capture rates much closer to what the institutions themselves earn. For those prioritizing absolute safety, you can bypass the private market entirely and lend directly to the government using the RBI Retail Direct platform. Buying sovereign T-bills puts your money behind a government guarantee, yielding roughly 5.5 to 6%. However, this requires zero flexibility. A 91-day T-bill locks your cash in for exactly 91 days with no early exit. For cash reserved for goals 1 to 3 years away, we look at short-duration debt funds. These funds buy bonds with slightly longer maturity dates, pushing the gross yield up to the 7 to 8% range. Holding the fund long enough provides a major advantage in tax efficiency. You qualify for long-term capital gains tax, which takes a significantly smaller bite out of your profit compared to slab rate taxation. This tax efficiency scales your post-inflation profit, leaving you with roughly 13,225 rupees in real net return. This vehicle requires you to absorb slight interest rate risk and commit to that 1 to 3 year timeline to realize those tax benefits. Bypassing the bank requires matching your timeline to the right financial vehicle. Doing so legally minimizes your taxes and maximizes your real yield. Idle cash is not a single monolith. Different financial goals require different tools based on exactly when you need the money. This flowchart maps out a routing protocol for your cash. The first filtering question is, do you need instant UPI or ATM access to this money? If yes, keep 1 month of living expenses in a standard savings account. That inflation loss is the price of daily convenience. The second question, is this your core emergency fund that you might need within 24 to 48 hours? If so, route 3 to 6 months of expenses into liquid mutual funds. You gain better yields with only a minor delay in access. Finally, is this cash reserved for a specific goal, like a house down payment that is 1 to 3 years away? Route those funds into short-duration debt funds to maximize your tax-efficient growth. Look at this scale to see the final stakes. On the left, leaving 5 lakhs in a savings account results in a real loss of 4,900 rupees. On the right, placing it in a debt fund yields a real profit of over 13,000 rupees. This 18,000 rupee swing is the mathematical reward for cutting the retail middleman out of the equation. Banks provide necessary daily services. Financial literacy is knowing exactly when to pay for that convenience and when to bypass it for better returns. As always, consult a registered financial advisor before reallocating your specific portfolio to ensure your money is actually working for you.